Hello, fellow Rebel Capitals. Hope you're well. I'm here with my good buddy, Jeff Snider, and there's a lot going on in global macro, that's for sure. So, Jeff, let's start off by diving into what's happening right now with these central banks. Everyone always talks about the Fed this and the Fed that, and we'll get into that in a moment. But there's a lot going on outside of the United States of America. So what's going on with the Chinese? What's going on with the Mexican central bank? I know they just had an emergency rate cut. Canada, India, Germany, UK, etc.
And on and on and on we go, right?
Exactly.
It's amazing. I think there is certainly though, from the American perspective, American audience, there's this idea, there's a focus on the Fed, right? And it's understandable why that's the case. And in many places around the rest of the world, there's a lot of focus on the Fed too. But oftentimes what gets left out of that is what everyone else is doing. Now, maybe some people pay attention to the ECB. That's another big one. And the Europeans have been doing basically what everyone else has, which is they started out cutting rates last year, sort of like, okay, according to their terms, rates are restrictive and they don't want to be too restricted because then that might lead to more economic weakness and maybe even trouble in the labor market, what they're trying to avoid. So the idea was they would keep rates restrictive and then gradually take them down to rate about where they think neutral is. And let's be honest, they have no idea what the neutral rate is, even if there is a neutral rate. But that was the plan. Let's take them off of restrictive, get them down to neutral very gently to make sure that we've got the inflation stuff taken care of, but we don't create too much weakness that it leads to a recession or worse. And never mind the fact that we're already in a recession. But that was the plan. And it started out and it lasted maybe a month or two before they all started to go, oh, wait a minute. The macroeconomic conditions and signs and signals that we're getting, not much as far as inflation risk and a whole lot more to the downside of the economy. And it really, it was almost one after another. So you had the ECB, which is the other major central bank. So they started out planning to cut every other meeting. That started in June. And it only lasted to the other meeting, which was September. So they skipped the meeting between June and September. And then September, they're like, okay, we're going to have to cut every meeting. And so they've cut everyone since then. And over the last two, while they've still cut by 25 basis points, there's been an argument inside as well as outside the ECB about whether they need to go to 50s. So they started out every other meeting, then every meeting, and now maybe we'll have to do some 50s. And that's the same kind of pattern that we see elsewhere. You mentioned Mexico. Mexico is maybe the best example of what we're talking about here. They started cutting rates in March of last year. So this is long before trade wars and tariffs and all the other excuses that you're going to hear in 2025. They started cutting in March of last year, thought the economy was just fine. Consumer price rates are coming down. So let's gradually lower it. And they actually were able to pause for 5 months. And then when they picked back up in August, they're like, okay, we might need to get going here. So over the next 5 meetings, they cut by 25 basis points until this past week where they said, okay, now we need to go to 50. And one reason why they said they need to go to 50 is because Mexico just put up most negative GDP in the fourth quarter since, I think 2021. So essentially the Mexican economy, what they thought was stable and steady and heading into disinflation, actually went past disinflation and looks like it's heading into recession, especially when you look at what's happening in the auto business.
And to be clear, that's Q4.
Q4, well before tariffs. You could blame trade war uncertainty if you really want to stretch it, but this all predates Trump. It all predates election. The global economy has been rolling over. And one way that you can tell it's been rolling over is by what these central banks are doing, because they're reacting to that weakness in the economy. And the more that they start to panic, the worse you know that they're seeing it. And if they're seeing it, then it's becoming pretty obvious.
The BOJ,
they're the only ones going in the other direction.
That's my point. Yeah.
They're the only ones going the other direction. And they're going the other direction because Japan was very late to the supply shock cycle. So they're still in the same type of situation that the U.S. and everyone else was in, just a year, 18 months behind. Plus, they have some of their own idiosyncrasies with the yen being so weak, which adds, a huge amount of cost to energy prices and food prices and everything else. Oh,
that's how they're getting the 3% inflation, huh?
Yeah, but that's the lone outlier. Everybody else is in the opposite direction. I think that's the point. When if your sole focus is on the Fed, you don't see what everybody else is doing. And by the way, the Fed did the same thing. They just stopped. They started to panic around September. They started out with a 50 to try to catch up to everyone else. And then they went every other meeting, and now they're paused because they think everything is settled down. But when you look around the rest of the global system, you look at what central banks are doing outside the U.S. and the Fed, You can see that the balance has definitely shifted in that direction. Another one I do want to point out too, the Bank of England.
Yeah.
Because the Bank of England had been one of those that was said, we don't want to cut rates at all. We're happy where we are. Let's leave them higher for longer rate here. Then they said, well, we'll cut every other meeting because, that seems to be the pattern. We'll gradually reduce rates. And then now the discussion is whether or not they need to cut every meeting and go to a 50 basis point. And one that I highlighted was a lady by the name of Catherine Mann, who is a well-known ultra hawk for the Bank of England, maybe the most hawkish central banker that there is on the planet. And she has voted against every single rate cut so far from the Bank of England until this last meeting where she switched. Not only did she switch and vote for the rate cut, she urged the Bank of England to cut by 50 basis points. So she went from ultra hawk, I don't want to cut it all, to let's double it up here and get going forward. So it's when you step back and look at all the central banks, you see it's a progression. It's a nearly uniform, constant, consistent progression from let's go carefully to just move rates down a little bit to, oh crap, things are going wrong. Let's start accelerating, get rates down further and faster.
Yeah. So the question then becomes, how long can the United States remain the outlier? What's the probability there that we get past this global recession and come out the other side and we never have a soft landing or a hard landing within the United States?
I think that's one of the biggest challenges here is to define what it is what are the central banks reacting to? What is the Fed reacting to? Are we really talking about a recession that looks like a traditional recession? Because that may not be the case. I think the last time you and I talked about this, George, you asked me about the unemployment rate. And I said, the unemployment rate may not skyrocket here. It may go up a little bit simply because the U.S. labor market, as well as the global labor market, is experiencing very unique conditions and circumstances. It doesn't look like a traditional recession. Even those in Europe, this is definitely a recession. GDP stopped growing more than 2 years ago. So you don't get the sharp downturn, but if it just stops growing and goes sideways for 2 years, call it what you want to call it. It looks like a recession to me, but that's what central bankers are responding to. It's not so much that the economy is just falling off a cliff. It's just utter devastation. And it doesn't look like 2008, for example.
Right.
Instead, what you're seeing is they keep expecting this stagnation, what they're all calling it. This is stagnation. So they keep expecting the stagnation to stop and a recovery to start. What ends up happening is the stagnation just continues, and then it continues. And so their panic is about the fact that they don't see the economy restarting their growth. And that's what they're really reacting to. So to take that and adopt it to the U.S. viewpoint, are we seeing the same kind of thing in the U.S.? Well, we are to a certain extent in different ways. I point out all the time the labor market. The labor market is not crashing. It's not falling off a cliff, but it is not robust. It is not good. It is way behind what a recovery trend would be, and it's getting further behind. So even though you have payroll growth and expansion, it's nowhere near enough to make up the gap that the U.S. economy really needs to get into a recovery situation. And so the Fed, because it's looking at the same statistics, but looking at them in the wrong way, thinking, well, payrolls grew by 200,000 or 300,000 in December. They grew by 150 or so in January. That's not bad. There's no urgency for us to cut rates because it's not as negative and dire as it might appear to be. The comparisons are much better with the U.S. economy than, say, Europe or Mexico or someplace else. So the Fed can stay on hold for a lot longer because it doesn't look like the traditional recession, where it looks a little bit more like one in these other places around the world. And the downside and the urgency to the downside looks a bit more immediate to, say, Mexico or Canada than it does to the Fed. So the Fed they don't have a 2008 scenario that gets them to really aggressively move in the same direction. But that doesn't mean they're going to be able to stay on pause all this time, because what the pattern is showing is that you expect the economy to really start picking up, and then it doesn't. And then you expect it to pick up, and it doesn't. And you keep going on with this. It doesn't pick up. It doesn't pick up. And eventually they have to respond to that weakness.
Yeah. I try to think about it in terms, or at least get the cues from the interest rates. We talk about this all the time. You go into negative swap spreads, which I'd like to go into in a moment, but just taking the basic stuff, the Treasury yield curve, I wonder if the price action we have seen, and therefore the signals that we've got from the Treasury market, have been indicative of what's happening outside of the United States as opposed to what's happening inside of the United States. Maybe the curve inverted as an example, just because all these other economies were suffering so bad. And that wasn't really an indication of growth and inflation expectations within the United States. I'm just trying to play devil's advocate here. What do you think about that idea?
Yeah, I don't even think that's devil's advocate. I think that's just the truth. The Treasury market, first of all, there is no Treasury market, German market, and government bond. I mean, it's basically a synchronized bond market. So you don't see, U.S. fundamentals reflected in U.S. Treasuries. You don't see German fundamentals reflected in German bonds. You see global fundamentals reflected with varying degrees in these individual bond markets. So that's why you see, for example, you can line up Canadian bond yields with U.S. Treasury yields, and they're almost exactly the same. They move up and down the same way, with some usually related to differences and differentials in central bank policies, but it's not. It's the same global economic fundamentals priced in each bond market with a little bit of different spin or through a different lens. So you're right, George. The U.S. Treasuries are not reflecting specifically U.S. macroeconomic fundamentals because there isn't really a U.S. macroeconomy that's completely separated from everyone else's. What ends up happening is you have global economic circumstances that play out in different ways and in different means and to different degrees in different places, but the overall direction is the same. So if you see interest rates or the Treasury curve that looks like, rates are going to be low and stay low, that's a reflection of global economic fundamentals that may mean the U.S. is comparatively better off. The old cleanest dirty shirt argument. That's kind of what it says, is that, okay, the overall global baseline is not good, but what does that mean for specific regions within the global economy? The Treasury yield doesn't actually tell you that. So you can have a situation like we did.
Then how much, if we're trying to exclusively figure out what's happening in the United States or what the smart money is predicting will happen in the U.S., how much weight should we give the Treasury curve?
Yes, I don't think the Treasury curve helps you predict exactly what's happening specifically in the U.S. It lays out the background for the global fundamentals, and then you kind of have to look at other signals. So that you can look at something that is specific to the United States. One that I've been looking and focusing on is wholesale gasoline prices, which you get from the CME. That's about U.S. demand for wholesale gasoline. Now, there are some global factors. Obviously, oil price is one of the biggest inputs into gasoline. So oil prices that are moved around for global reasons, but there is as much of a U.S. focus in wholesale gasoline prices at the CME as maybe you'll find in any other place. So if wholesale gasoline prices are unusually weak for a winter, that might tell you that, okay, the U.S. looks better than anywhere else, but that doesn't mean it's getting off scot-free.
Okay, so I would assume you would say the probabilities of the United States avoiding a recession if the entire world is going into a recession is pretty low.
Again, we have to define our terms, George, because what I would say is that we've been in a recession. We never really recovered from 2020. You look at all the statistics, especially the labor market statistics, and we're nowhere near a recovery. So it's tough to say we're going into recession when you can't really argue we came out of the last one. It's one of the things that's really difficult about all this is it doesn't look like the traditional cycle that we're all used to. Like when you say,
Jeff, most people would say, okay, you've got all this anecdotal evidence, that's for sure. And then you've got some charts and some data that back up what you're saying. But at the end of the day, the unemployment rate is still low. And we've got 3% real GDP. So until I see the unemployment numbers or the employment numbers go negative, like we saw in 2008, and until I see, at least a quarter of negative real GDP, then it's not, fine. We might not be booming, but we're definitely not, we're not even close to recession. And then you compare that and contrast that with what you hear from the man on the street, and it's completely different, obviously, which is why I think Trump got elected. But how do you reconcile all of that to someone who's very bullish, right?
Yeah, what I'm saying is you're looking at the economy all wrong. So you say, okay, GDP is growing at 3%, which that's what it's done. I mean, almost consistently at 3% for the last year and a half. But it's not enough GDP growth to close the gap for the employment. You say unemployment rate is low. We have a participation problem yet again. So participation rates have gone down because there are fewer people working now than there needs to be working. You can look at the establishment survey, the household survey. So the establishment survey is growing by 200,000 per month when it needs to be growing at 400 or 500,000 per month. So the comparison to make isn't, okay, it's 200,000 this month. That's pretty good. It's not a recession. The comparison to make is it isn't 500,000. So some data that matches the perspective from the man on the street. And I agree. That's why Trump got elected, because he basically said it's not booming. Whether you want to call it a recession or not, I think that's a distraction. This is a unique cycle that's playing out very different than others. And if you're looking for a 2008 style version of the economy, you're just not going to find it. But that doesn't mean it's not creating real big problems, not just in the economy too, just because it doesn't look like something like 2008 or 2001 or something else. But I think that's one of the biggest problems that we have is when you look at, we talked about this during the election all the time too, where, the Biden administration, they said, the biggest amount of job growth in history. And the Trump people would hit back and say, well, yeah, those are just jobs that were reclaimed. And it's the sad fact of it is that they did not reclaim nearly enough jobs as a recovery demanded. So whether GDP is positive, and I know that's the usual way that we interpret economic circumstances. What I'm saying is that's the wrong way to interpret these circumstances. And that's what central bankers are trying to come to grips with, because they've been trying to interpret all of these things in the traditional way and finding that it's not really working. Politicians in Europe and other places, they try to do the same thing, and they find themselves on the wrong end of the electorate, because the electorate is tired of hearing how good things are when they know it isn't good. So maybe the statistics don't look like 2008, but that doesn't mean that we're not in a very bad shape, or not in bad shape and headed further in the wrong direction. Because at this point, in order for things to start going right, we know 3% GDP, we need 10% GDP. We need 10% GDP for like a year and a half straight in order for things to get really back on track. We need payroll growth at 500,000 a month for a year, just to have a prayer of getting back to even close to the pre-crisis or the pre-2020 baseline. So we're not really conditioned and set up to look at the economy under these circumstances.
I understand. So I guess, what do you think the probability would be of the United States, the actual numbers, the headline numbers, starting to look more like Europe? Because I also want to caution people that although this time may be more like a balance sheet recession that we saw during the dot-com, just because we have seen the 10-year go up and just because you do have positive GDP, it doesn't necessarily mean that it's not 2008. That's one thing I always point out is, when the Fed started cutting rates back then during that cycle, it was you have the same starting point at 5.25%, same date. And now what's different is they pause in January. Back then they were cutting aggressively in January. But the 10-year Treasury from March to June, July in 2008 went up by 100 basis points while the Fed was cutting dramatically. So just because that's happening now, again, it doesn't mean that we're in 2008, but it doesn't mean we're not in 2008. And I also like to point out the CPI from September of 2007 went from right around 3%. And you fast forward to June or July of 2008, and it was up at 5.6%. So a massive increase in the CPI. And during this time, what was the mainstream narrative? It's the Fed's cutting too much and Fed's cutting, exactly, inflation. The Fed cut too much. The economy is on fire. The Fed cut too much relative to the underlying fundamentals of the economy. And therefore, you're going to get this consumer price inflation, the reacceleration. And if you look at the Wall Street Journal in June, July of 2008, they're talking about how the Fed will likely have to start hiking rates going into the end of the year. And we all know how that played out. So again, I'm not predicting that it's the same, but I just want to highlight the fact that just because we have the numbers going in the opposite direction, it doesn't mean that it's not the same, because we saw the data play out in a similar way back during the GFC.
Yeah, and I think it's really about what we're talking about is different degrees of weakness. And so you have an economy that is not resilient, that is weak and showing signs of being weak and getting weaker. And then it's deciding about how that plays out and what parts of the economy suffer from that most. And again, there's geographical differences as well. So it's really difficult to kind of piece together. You want to focus on one place or another. We can't follow any specific template. It's not like the economy always follows a template, which It seemed like that was the case in the United States with recessions. Milton Friedman's plucking model, which he basically said recessions looked the same in the entire post-war period until 2008 came along and shattered that template completely. So it's difficult to say, okay, the recession looks like this and it only looks like this. Well, there's different ways that recessions can play out. And what we're really saying here is that what we're seeing in 2025 through the markets, through the data, through central bank reactions, is that there is some degree of weakness that is over and above what we would consider acceptable. And what does that actually mean for 2025 is very difficult to say because, again, unique set of circumstances make it hard for us to make a lot of comparisons. We don't know. The possibility you just cited, George, is not out of the question either. There could potentially be a more traditional type looking recession up ahead of us here in the second half of 2025, for example. It may be that tariffs are the straw that breaks the camel's back, and what was sideways weakness suddenly becomes, the downside off of a cliff. I think that's the real danger that central bankers are actually reacting to, or actually trying to prevent. They're seeing the sideways in all their economies too, and thinking the longer this goes sideways, the greater the chance it goes over the edge and off the cliff. Therefore, we want to do everything that we possibly can to lower the chances of going over the edge. And that's really where all these central bank rate cuts are coming from. They see the sideways and they're worried about the V shape showing up afterwards.
And what makes it even more difficult, Jeff, is number one, you've got to compartmentalize between the economy and the stock market, which is very tough for the retail investor to do. And then
for the public, right, George? I mean, we're taught that stock market is the economy is the stock market. You hear it all the time. It's those two are used interchangeably.
Yeah, I would argue more recently there's probably an inverse correlation because the whole good news is bad news and bad news is good news. But then as an investor, what you have to do, and this is where it gets really tricky, is you have to realize it doesn't matter it matters what the market thinks. So even if you're listening to Jeff Snider and you're saying that makes a lot of sense, what he's saying, that we should be at 10% GDP growth, or we should have 500,000 jobs a month. And if we're not there, then we're way below trend. And that means the standard of living is not what it should be. And the economy is not running on all 8 cylinders. And you could buy into that. Yeah, that could make total sense. I'm probably in that camp. But then you have to realize that if you're setting up your portfolio, none of that matters. Because if the market looks at 3%, and if the market looks at 150,000 jobs with the establishment survey and comes to the conclusion that the economy is booming, well, then the price action is going to reflect what the market thinks, even if the market is wrong. And that's where it gets so darn complex, I think.
Yeah, I would, the market is looking for the same things you raised, right? The market says, historically speaking, stocks go down when we see a traditional type recession. So when we see negative GDP and negative payrolls, that's when stocks go down. And so for the last couple of years, really going back to late 2022, the market has been, okay, if we see signs of negative GDP and negative stocks, we're going to sell, sell, sell. But if we don't see those signs, we don't care. It's almost like a bimodal model, right? It's either the economy is growing and it's just fine, or it's falling off 2008 style.
Right.
And as long as we're not in the falling off 2008 style, it's buy.
That's very well put. And then when you combine the other variable of the Fed dropping rates.
Oh, that's even better. That's more punch bowl, baby.
Exactly.
Yeah, so I think that's the challenge here, is because what we're saying is that the economy sucks. We know it sucks. Central bankers are telling it sucks. Politicians are getting thrown out of office because it sucks. Yet stocks are zooming ahead because stocks are only afraid of 2008 style recessions.
Yeah. Why are the economies so interconnected? So why is it so hard for the United States to avoid a sucky economy? If China is in recession, UK, Germany, Eurozone, etc. And the way I would answer this is it has a lot to do with the global monetary system, because it's just a network of bank balance sheets. So if you have risk outside of the United States, you basically have risk inside the United States as far as a lack of liquidity, because regardless of what the central banks are doing, at the end of the day, liquidity revolves around the commercial banks, not the central banks. But I'd love to hear the way you would respond to that question.
Yeah, there's a whole different ways in which you have these interplaying variables, right? I mean, monetary systems, one, global marketplace itself, commercial marketplace, non-financial marketplace. You have large multinational companies, large companies that are reacting to weakness, say in Europe. Well, they're not going to just change their operations in Europe. They might trim some of their payrolls in their U.S. headquarters based on European weakness, because that's going to reduce their earnings and earnings potential based on, their global operations. But yeah, to go back to what you said, I think one of the things that you can see this visibly, where there's the global monetary and financial and banking regional banks. Kudos to them. It didn't spiral out of control into some type of massive 2008 and worse banking panic all over the world. So great job, Federal Reserve. No, we don't even have to worry about the bank crisis. It's just a curious little footnote that'll go into history. But if you look at economic statistics all over the world, as well as market prices and behavior and interest rates and everything else, you see a very clear inflection March of 2023. In fact, in the bond market, you see it in Germany, you see it in Canada, you see it in the United States, where interest rates that were following along with central bank rate hikes stopped doing so March 10th of 2023. And ever since then, whether it's Germany or Canada, the US, doesn't matter, long-term rates and even short-term rates, like the 2-year maturity, have been sideways, even though central banks continued to hike for a couple more months afterwards. The entire global bond market said, SVB, this is going to be a big deal, not just for the U.S. This is not just a U.S. regional bank thing. This is going to be a big deal for the entire global economy. And you can see a whole bunch of macroeconomic statistics. I just working on Germany's GDP, or Germany's industrial production, which is the saddest, most depressing statistic you'll see for a number of reasons. I mean, German industrial output is down to around where it was in 2010. I don't mean growth rates or negative growth rates. I mean actual level of output, where it was coming out of the Great Recession, back in 2010. Right. And where did that really start to fall off again? Yep, March and April of 2023. So it never recovered. And what little recovery there was in German industry stopped in March of 2023. You could say that's a gigantic coincidence, and that's just, or you're just confusing correlation for causation, but that's far from the only one. And so you put that together with the market behavior, as well as so many macroeconomic statistics. When did the U.S. unemployment rate begin to rise? May of 2023, couple months after the low, a couple months later, May of 2023, First Republic had just failed. So either these are all gigantic coincidences, or you really need to start looking at the global system as a global system, because otherwise you're left thinking, what does the failure of a couple U.S. regional banks have to do with German industry and German bond markets? It's like you said, George, it's a globally interconnected financial and monetary system where if you have major problems and major fears over here, what seems to be an isolated part of the system, it does have impacts that ripple through the entire system and come out on the other side of the world. And let's face it, there's no shortage of things to be concerned about where it comes to global economic and macroeconomic factors and financial factors and banking factors. We haven't even touched on China yet, which is a huge one. And there's absolutely relationships with the Chinese as well. So
talk about China for a moment, Jeff, because I don't know that Americans know the problem is over there. And I know they've had just a massive balance sheet recession where the real estate prices have contracted by 30% or so, which doesn't sound like a big deal until you look at the total number was 60 trillion is the largest asset class in the world. And so you had about $20 trillion of purchasing power just get wiped right off the top right there in the last, let's say, 2 or 3 years. And you got to say, how on earth does that impact aggregate demand and purchasing power going and mentality of the consumer? But then what's weird is that they don't have negative GDP. So how on earth are they having this massive balance sheet recession or depression? And while at the same time, they're still able to grow at 5%.
Well, we don't know that they don't have negative GDP. We don't know that for sure. And I don't think we'll ever know for sure because GDP is notoriously unreliable in China. And there are a number of different alternative calculations that are out there. The Conference Board puts one together, and there's a couple other sources.
Oh, the Conference Board puts one together for China?
Yeah, they look at China and look at different statistics. In fact, I think it was former Premier Li Keqiang who had a sudden heart attack at the end of, what was it, 2023 or 2024? 2023. He said in private, he said, I don't look at GDP either. I look at electricity output and a couple other real economy statistics. So the point is that all of these others, it's nowhere near 5%. It's probably closer to 1, maybe 2%. And there's a chance that every once in a while it actually does turn negative. But that's getting back to your main point, George. I think what you're seeing is not lost purchasing power just yet. That level of deflation hasn't actually hit the real economy because the banking sector has shielded the real economy and has been sort of the marginal shock absorber for the entire Chinese system up until more recently. So as the real estate sector has gone down, it's really been the banking sector that has absorbed most of that, and it has been able to, squirrel that away and hide it away from the public. As long as the banks were continuing to lend, they were hamstrung. They were certainly constrained by all the hidden losses that were piling up on their books, but they were able to at least maintain operations because they were still making profits off of lending in other parts of the real economy. The industrial economy in China in the immediate aftermath of the pandemic was really good because a lot of production moved over there, especially related to medical products and things like that. So in the early pandemic phase, the Chinese banking system, even though it was hobbled by the real estate sector, was still able to do some other things and kind of balance the books enough that it could maintain sort of a steady but slowing course. And then that all changed really end of 2023 and really last year. Suddenly it was like, okay, the banking sector was no longer getting the shock absorption capacity from the rest of the Chinese and global economy that it was able to do. So the banking sector started to shut down, which means that the shock absorption capacity that the banking sector was performing up until then, that's starting to go away as well. So I think that's the primary reason why you have such a massive setback in real estate, but it hasn't really crashed China's economy.
Right. And then go into the stimulus, quote unquote.
The bazooka, right?
Right.
So the Chinese had a bazooka that everybody went crazy over, and it didn't show up. It didn't show up anywhere other than the stock market. It didn't show up it didn't show up. I mean, the bond market, you had yields that rose 10, 15 basis points at the long end, and then they just kind of went back down again. And then rates actually plunged in December all across the Chinese bond market. So they had this major bazooka, but it wasn't really, it's one of these things that's a unique set of circumstances that we're not necessarily used to seeing. It wasn't a bazooka in the respect of, say, China 2009, 2010. They didn't commit to, building another real estate bubble because they already have a real estate bubble to try to deal with. What the bazooka really was and what it was aimed to do was to shore up sentiment. So what they said was, we're going to bail out all of these local governments that are basically broke and bankrupt and can't keep up with even just basic services. So we're going to do a debt swap with them. The central government's going to borrow trillions of yuan and then transfer those proceeds to these local governments to try to alleviate some of the debts. And really, that's also a backdoor bank bailout too. Plus, they were going to look at trying to buy some of these unsold, unfinished houses to try to soak up some of the supply. But as you know too well, George, nobody has any clue how big the overhang of supply is in Chinese housing. I mean, I've seen statistics where they have enough housing to house, 3 times the population of China, which is just mind-bogglingly massive. So they're going to buy up some housing. What the bazooka was focused on doing was trying to shore up sentiment, especially focused on local governments and the real estate sector, to try to just stabilize the situation and therefore hope that with positive sentiment and a stable government situation as well as a stable real estate market condition, that the rest of the economy could just start growing on its own. And so that's why you saw them talk about bigger and bigger numbers, and they're just kind of throwing them out there. And then you would see even Western media sources saying, okay, great big numbers, but where's the details? What are you actually going to do? And they would respond with even bigger numbers. And the Politburo would come out with the next communique and readout that was an even stronger tone. So it was really just this major effort to shore up sentiment without really having any idea how. And I think what the real purpose was is that the Chinese authorities don't really know what to do here. They're really kind of stuck between a rock and a hard place. They don't really know how to get out of it. And they're sort of kind of throwing a Hail Mary at it. Of course, they've never used that term. They're throwing a Hail Mary at it, trying to, let's get the marketplace to just, to be optimistic. Let's get stocks to soar ahead and see if we can't spark something in the real economy and see if that leads to the stability. If we just talk about these gigantic numbers, if that's enough to get us out of the situation. And of course, there was really no impact on the real economy that you could see, no impact on the markets outside of the stock market. Commodity prices, I mean, you saw copper kind of move ahead, but then it fell back again. Commodities weren't really enthused about the bazooka either. So the failure of the bazooka is another one of those central bank signposts that says things are really, really a lot worse than they appear to be.
And they have a lot fewer tools.
They have no tools, right? I mean, that's kind of the failure of the bazooka is like, hey, we tried this and nothing happened. I mean, it didn't just, it's not like it created a burst of activity and then it just kind of slowed down on the other side. It didn't even get the burst of activity. They didn't even get the plus side of it. So it really does show that how big the problem is.
And what's unbelievable is the narrative in the mainstream financial press and with the quote unquote experts is never, ever, ever that stimulus didn't work. It's just they didn't do enough stimulus.
It's always not enough, right? I call it magic number theory. That was like Paul Krugman in Japan, right? He's like, okay, if this number didn't do it, then you got to do this number and this. Eventually, if you keep doing bigger numbers, you'll find the right magic number that'll work, which just makes the stuff unfalsifiable. It doesn't matter how many times they do it; they're always going to do more and bigger. But yeah, the Chinese. I mean, the funny thing is, you look at some of these Chinese variables, and they match up in a line with Western variables, and you don't think that should be the case. You would think that if anywhere out of the global economy, China is the one place that is a Chinese economy. It's the most separated economy as there is from the rest of the world, because it sounds like that because the Chinese government is top-ending. They don't really fit in the overall global landscape. But then you look at Chinese bond yields, government bond yields, and they line up and correspond nearly exactly to something like U.S. Treasury yields or U.S. dollar interest rate swap spreads, which just reinforces a global system with only variable consequences each different part. So the more the Chinese suffer from their own problems, the more that's going to be a problem for everyone else, which, I mean, just from a mercantile perspective, makes perfect sense, because how much growth around the world in the 1990s and in the 2000s was dependent upon, first of all, China manufacturing all the goods for the rest of the world, but also in manufacturing all the rest of the goods for the rest of the world, having to build up its own capacities to be able to do so. Right. So, Brazil was able to pull itself out of poverty in large part, because it was upstream of China. So if China is hobbled, that's going to have an impact on Brazil or, Africa and rest of Asia. So even just from a mercantile perspective, if things are going bad in China, that's going to go bad upstream of China.
But why would it go bad in the United States? Because we are obviously a net importer. So we should be isolated from that dynamic.
You would think so. But, a lot of global companies that are perceiving opportunities from a booming China, some of that would spill over into the United States. So conversely, if you have global businesses that are perceiving nothing but risks and problems and nightmares from China, that's going to spill over too. It's not going to be a huge direct impact. It's not going to be like as China falls off a cliff, it's going to drag the U.S. with it, but it will be a drag on the United States and Western growth overall. It's, you can't get away from it. But in this type of global system where everything is connected to everything else, even if it's not as bad as what we're seeing in China, there is still a negative, call it a discount discount on U.S. growth from what's happening in the Chinese system.
And I also want to connect the dots on how what's happening in China impacts global dollar liquidity, which will definitely impact the United States to some degree. So let's back up here. You're talking about how bad things are in China. And I know the answer to this question, but I just want to kind of lead people through the discussion. Were there Eurodollar banks outside of China and outside of the United States, outside of the purview of any central bank, that were providing dollar liquidity to the Chinese banks? And does what happened to the real estate sector, therefore the Chinese banks, impact the balance sheet or the willingness to take risk to those Eurodollar banks that lent those dollars for that growth that you were talking about before that propped up the whole world?
Yeah, there's also, not just Eurodollar banks, but also the bond market. The Eurobond market's where most of the Chinese real estate losses have been posted. In fact, the Chinese have made an effort to make sure that offshore investors have borne the brunt of these real estate losses more than anybody onshore, which is another reason why the banking sector has been able to get away for as long as it has. Because, all of these euro bonds that were issued by China Vanke and Evergreen and Country Garden.
You're talking about euro bonds. You're talking about denominated in the euro.
No, euro bonds are offshore denominated. So from China's perspective, these are bonds that are issued outside of China, usually through Hong Kong, but also there's some other ones, Singapore and other places.
Okay, so that's where the euro comes in, but denominated in what, dollar?
Dollars, euros, anything, any currency other than the local currency of the issuer. So in the euro bond market, it's mostly in US dollar denomination, but it really depends. It depends on the circumstances. A lot of global businesses will borrow in dollars, or borrow in euros, or borrow in yen based on, whatever individual corporate functions that they're trying to perform. But, we have a lot of these euro bonds that were issued in US dollar terms and euro terms that's where most of the losses have been. So as these Eurobond markets are taking these losses from Chinese real estate entities, you got to believe. I mean, human nature says if you've been beaten and you've lost money, substantial amount of money lending to China, you're going to be chastened. You're going to be scarred from the entire experience. So as the Chinese sector posts more losses on the Eurobond market, as well as making it more difficult for Eurodollar banks to provide funding, it's not just, okay, we're gonna avoid China from here on out. It's like, okay, if China's causing us this much problem, should we look at other places too? Especially realizing that China is a big part of the entire global system. Doesn't that just raise the risk? We're going to have the same experience with, say, Vietnam. Well, maybe not, but it's certainly going to take a second look and really investigate that possibility. So rather than just issuing bonds and taking debt at low interest rates and doing it dependably and rolling over funding dependably as you did before, the fact that China's posting all these losses and creating all of these headaches, you at the very least are going to take a second look at everyone else, if not a third and a fourth look. And in many cases, you're going to say, no, thank you. Or you're going to say, I'll lend to you, but I'm going to need higher rates. I'm going to need some kind of assurance and a bigger return in order to make it worth my while to overcome these risks. So even if it's not just shutting down funding, you're raising the cost of funding, which creates a greater friction for everyone else downstream of where China is.
Let's connect some more dots. So you're that Eurodollar bank that was lending not only into China, you were also lending into, let's say, the Japanese banks like Norinchukin. So you're lending to Norinchukin, so you're going to stop lending as much, or you're going to need a higher interest rate or more collateral. So their dollar funding costs go up on the liability side of their balance sheet, which would in turn incentivize them to take more risk with the asset side of the balance sheet, which could result in them going into, let's just say, CLOs in the United States. It's backed by commercial real estate, which is just a game of musical chairs, instead of going into, let's say, treasuries. So what you've done there is that problem in China has equaled more of these systemically important banks taking more and more risk with their balance sheet because they don't have a choice, while the global dealer banks are trying to de-risk their balance sheet because of what's happening in, let's say, China. So this is the cocktail that you've got to think through.
Yeah, it's even not only the Japanese banks doing what you just said, but they're also redistributing their portfolios in other ways where they might perceive, they need to generate more return from the U.S. And so they might perceive that CLOs are securities. They're lower risk relative to, say, lending to some financial firm in Malaysia. So where before they were perfectly willing to, lend to Malaysia in US dollars because Malaysia represented a relatively low risk opportunity. Now, in the wake of everything that's happened over the last couple of years, they're like, now I'd rather just take my risks with US dollar denominated CLOs than lending US dollars to Malaysia. So there's also a portfolio rebalancing impact that we don't necessarily see or track either, because there's no statistics for Japanese banks sending Eurodollar flows over to Malaysia or Brazil or someplace in Africa, what they now perceive of as being much more risky because of everything that we just talked about here, and therefore demanding a higher return that somebody in Malaysia or someplace else just isn't able to meet, because once you get past a certain interest rate, it's just like, okay, I can't really do that. So as the Japanese are re-looking and reevaluating the risks of what their activities, they might look, okay, US CLOs they look risky to maybe outside the system, but they're less risky in comparison to some of the other things that they used to be doing. Right. So there's a whole chain reaction based on, this one thing that happens that creates this need to reevaluate risks throughout your systemic your portfolio and everything else that you're doing. There's a chain reaction that isn't just Japanese piling into CLOs. They're also probably piling into CLOs at the same time they're not doing some other things. So it's the Eurodollar used to be described as a long chain of liabilities. And while that's probably oversimplified, it really is sort of that kind of interconnected case where something over here, it's not quite the butterfly effect. It's a little bit more direct than that, but something happens over here and it ends up, causing some firm over here to lose its financing at relatively predictable and cheap and effective and efficient financing.
And if we back up a little bit here for the viewer, I want to highlight that only works to a point. So what Jeff is talking about is the rebalancing of the Japanese bank's balance sheet, assuming they're getting funding from the global dealer bank at let's just say 5%. So then that CLO at 7% makes sense. But what happens if
5 3/4?
Yeah. But what happens is if the risk increases further in China, Malaysia, Germany, the UK, Canada, etc., then what happens is that global dealer bank that was lending at 5%, up from 3%, goes up to 7%, to a point where now the Japanese bank is like, well, I can't make it work at 7% because I'm getting 7% on these CLOs, so I'm not going to, no upside and just take the risk. So then they pull back from the CLOs. They have less liquidity, which makes those prices go up, which impacts financial assets and the banking system within the United States, which, as we know, would impact the United States economy. So also I just wanted to put all those pieces of the puzzle together for the viewer, because so I don't think the retail investor really thinks this stuff through. They just look at the banking system and the economy as though it's something exclusive to XYZ country. And you've got to step back and take a more global view.
Well, that was the one thing too that led to the stock market crash in last August, was the fact that there is a connection even with the stock market. Everything you just said, as Japanese banks were selling their CLOs, and really that spiked credit spreads. And it's pretty substantial. Even though it didn't stick around, there was a substantial liquidity issue. As you just said, without Japanese banks providing a bid for those CLOs, as soon as a lot of participants were forced into fire selling some of those assets, spreads just blew out. I mean, which means prices went down. You had not quite fire sale prices, but stress levels of pricing. And as credit spreads blow out, that led to a spillover in stock markets, because stock markets leverage positions in stock markets. There's also a relationship there with perceived volatility. So you have a volatility in corporate credit that actually becomes volatility in equities, which leads to essentially margin calls all throughout the global stock market too. So you even have that connection between something like this and U.S. stocks, because let's remember the Dow Jones Industrial Average that one Friday, or was it the Monday morning, was down 1,000 points too. It wasn't just Japan stock market and the Nikkei. You had stock markets all over the world that were liquidating because of something that really didn't have anything to do with equities. That's how globally interconnected everything is.
And I want to point out, Jeff, this whole last 15 minutes talking about global dollar liquidity, we have not once mentioned the Fed's balance sheet or bank reserves, have we?
No.
And the reason I want to highlight that for the viewer is because what you're told in the mainstream media is that global dollar liquidity revolves around the Fed's balance sheet. But if you actually think through what we're talking about with Malaysia, what's happening in China, Norinchukin Bank, the global dealer banks that are outside of any central bank purview, you start to see, wait a minute here, the Fed's balance sheet really isn't going to provide liquidity to that global dealer bank. The banks are providing their own liquidity to one another. And the only thing that really impacts the willingness to provide that liquidity is risk. It's all about risk. If the risk, you're going to have infinite liquidity, regardless of what, and if risk is high, you're going to have very low liquidity, regardless of what the Federal Reserve is doing.
Yeah, the argument they really make is that, say you're JP Morgan or some big dealer bank, that perhaps you are less averse to risk if you have access to more bank reserves that are outstanding. And it's a kind of a tenuous argument, but that's really the only one that they can make. That where bank reserves maybe some way, some fashion, some way that we can't actually determine or put our finger on it, some way the level of bank reserves affects the behavior of dealer banks. And of course, you don't find any evidence for that because it's kind of an absurd proposition. But that's really the only way that you could connect the Fed to what banks are doing, whether inside or outside the United States, but really outside the US.
Yeah, once it gets to a certain point, then I would agree. So 99% of the time, I don't think the Fed impacts liquidity at all. But that 1% of the time, I think they do. So like them coming in with the BTFP and just bailing out the banks, then okay. In that instance, global liquidity is probably going to be higher than it otherwise would be for a short period of time because all those banks would have gone bust and the amount of risk would have skyrocketed. But that's during the 1% of the time they're actually bailing people out. If that is not a perceived risk at the time, then during the other 99%, the market's just whistling by the graveyard and they are just providing that liquidity as if everything is fine. And regardless of whether the bank reserves are $1 trillion higher or $1 trillion less, it doesn't impact the global bank's ability. I think that's the key. There's a difference between ability and willingness. It doesn't impact their ability to provide that dollar liquidity to all these other entities around the world.
Yeah, because that's what ultimately matters here. It's always about circulation.
Yeah.
Circulation, as you just said, George, it's about whether or not banks want to do it. You can lead a horse to water, but if they don't want to drink, they're not going to.
Yeah, absolutely. Okay, so why does supply of treasuries not matter the price? Because you got to admit that is very counterintuitive, and it matters to Argentina, it matters to all these other countries. So why on earth does it not matter if Janet Yellen or now Scott Bessent comes out and issues another $1 trillion at the long end of the curve?
Yeah, exactly. Right. I mean, it does. I mean, you understand exactly where people are coming from because it seems like, Jesus, we're 35, 36. You don't even know how many trillions of debt we are. And at some point that would have to be catastrophic. Right. But then, of course, you remember Japan. Japan's gone way farther than we have. So ultimately, at the end of the day, supply of government bonds is not the determining factor in prices and therefore interest rates. So it has to be something else. So something else convinces the marketplace to buy an additional supply of treasury and do so at a relatively similar price. What is that something else? And it's a combination of something else, and it's growth and inflation expectations. That's what bond yields are. So if growth and inflation expectations are low, that simply means the market will buy up whatever safe and liquid assets are sold into the marketplace because that's what those are the key financial characteristics that the market wants. So basically the federal government, for better and a lot for worse, is essentially giving the market what it wants. So that's why it seems like there's a perpetual bid because the market wants this safe and liquid instruments for a variety of different reasons. And it doesn't matter how much supply there is. The market says, give me more, give me more, give me more. I'll take it.
Our original topic or original point here, it isn't necessarily the market's outlook for growth and inflation in the United States, even though it's the U.S. Treasury market. It could be growth and inflation outside of the United States. And if that's low, well, I'm still going to look for safe and liquid. That's going to be the Treasury market, even if I might think that the growth in inflation is in the United States is higher than the 4% I'm paying for that 10-year.
Well, so, use the Japanese example, right? So Japanese love to buy U.S. treasuries during periods like this, even though they know that the U.S. government is broker than anything we've ever seen before. And the reason they do that is because they need to be in U.S. dollars and need to be in the U.S. dollar market. And there are periods where they'll accept having a negative carry, which is their funding costs are higher than the returns that they get on U.S. treasuries. So they'll demand more U.S. treasuries because they're that risk averse to the overall situation. The more risk averse they are, the more they want to buy treasuries regardless of what the interest rate is, simply because they provide them with the characteristics that they're in demand, which is safety and liquidity. I know it's another thing that people struggle with. It's like, how can U.S. treasuries be safe and liquid when you look at the balance sheet of the federal government? It's not really about credit risk. It's about liquidity more than it is safety and credit risk. It's basically because there's the deepest, most dependable marketplace for U.S. Treasuries. That means that the price that you get on a Treasury today is very dependable was the price of what you might get tomorrow if you have to sell the damn thing. So it's about the liquidity characteristics of the marketplace, and simply because of historical and traditional reasons, that's where the deepest market has always been. So the federal government is essentially piggybacking on these unique characteristics to take advantage of this unrequited demand for safety and liquidity. Politicians figured out, and starting with the pandemic, issue as much debt as they want and pay no price for doing so. The only price that they're paying is the Federal Reserve raising rates at the short end of the yield curve.
And the distortions of the U.S. economy.
Exactly. So it's like, from a politician's perspective, why wouldn't they issue more debt? If there's no real cost to doing so, then of course that's what they're going to do. So, but to get back to the original premise here, it's the price of treasuries is determined by the needs and desire of the actual marketplace itself. And as long as you're into a high risk averse, high demand for safety and liquidity, the market's going to buy whatever it is the Treasury will supply, because any credit risk from the Treasury supply is down the road, assuming it happens anyway, which is a very low probability to begin with. That's way down the road. The factors that are driving demand for safety and liquidity are today, so they come first. So I don't care about Uncle Sam's credit risk from 2050. Right. I care about what's going on today, that I might need to have a liquid asset on my hands that I can use as collateral. I can sell at a moment's notice.
I think the key word there that people have to focus on, Jeff, is utility.
Yeah.
Utility. When you're thinking about a treasury compared to a German Bund or even a JGB, when you're thinking about the dollar compared to the Argentinian peso, think about the utility of the network. So I always like to encourage people to think about the dollar not in terms of a currency, a reserve currency, but actually a network. And you have to ask yourself, how much more utility provide these global banks and mega corporations than the utility, let's say, provided by the network with the Brazilian real. And to get people to understand the difference between the utility of those two networks, imagine using a flip phone today, like a Motorola Razr, like that had no apps. You could call someone and you could text someone barely
when you push the numbers.
Right. But remember that's about it.
They would function, right? They would function very minimal, but they function.
But that's an example of the utility that you have with the network of, let's just say, the Brazilian real. Okay, we'll compare that to the dollar network, which would be represented by this iPhone, where you can get any app you want. You can get thousands of apps to make your life better and hopefully more productive. So what are you going to choose? The iPhone, or are you going to choose a flip phone? And that's why people choose the network that is the United States dollar. Because I think when people see the utility of a currency or a currency network, they think of it in terms of their own life, where there is no difference between the utility of a Brazilian real and the dollar. It's just, I can take it out of my pocket, I can give it to someone, and they can give me goods or services. But what you have to understand is the utility that represents for you is not the utility that it represents for a multinational corporation or one of these massive banks that create this network that will create the probability of that global dollar network remaining the reserve currency, which in turn will lead to that the treasury market will in fact be the bond market for the entire world. It always goes back to that one word, utility.
Yeah, and you can make the case that treasuries are the actual currency as for the Eurodollar system. They're more currency than cash.
It's base money, right? It's the base money.
Pretty much, right? And it's a tough concept to get your mind around, but once you do, a lot of things start to really make sense. And just to build on your point about utility, George, the first time that somebody used a credit card in a foreign country to get money from an ATM was a fellow who was from Arkansas who traveled down to Sydney. This is like 1983. He put his Visa card in an ATM in Sydney, Australia, and got Australian dollar currency, even though he had a bank account at some small regional bank in Arkansas. That's the power of the utility. there's a whole story of the network behind that. To be able to use a credit card in a foreign country in the early 1980s and get currency that was spendable in that local country, all because of the network that was behind it that allowed that to happen. That was 1983. So the capacities and capabilities, as well as the reach of that system and that network, has only expanded since then. And so with the U.S. Treasuries being the central part of that network, at the very least, there's demand for that as currency within that system.
Yeah. And we're not saying that it's a good thing, because although it's great that the world has this system that it can leverage, at the same time, it's highly detrimental to the U.S. economy, because it allows the politicians to spend and spend and spend. And even Donald Trump, I mean, let's be honest, he's going to spend more. And that government spending itself, not necessarily the debt, but the spending itself, is what distorts the economy, makes it less efficient, makes us have fewer goods and services, which at the end of the day decreases the standard of living, especially for the poor and middle class. So I want to make sure that people recognize we're not saying the U.S. can spend money with no cost.
No, there are always costs, right? That's what economics is. It's all about trade-offs and where they end up coming out. But yeah, we're not advocating for this format. We're trying to tell you this is the way it is. Right. And therefore, because you understand the way it is, then you can evaluate the implications. And one of the implications is, as you just said, George, government deficits under this type of situation are inherently deflationary or disinflationary, if you prefer, rather than inflationary. For that reason, because it makes an economy more rigid and less efficient, because you have stupid politicians who have access to unlimited funds, as we're finding out with Doge, doing incredibly stupid and wasteful things with all that money. That doesn't create inflation. It creates more of a drag on the economy, because an economy, a long-run sustainable economy, runs on efficiency, doing the most with less. That's what economics is all about. So when you hand politicians a blank check, it doesn't necessarily, it could become inflationary depending on the circumstances, but more often than not, it just makes everything worse. It makes everything more wasteful, more inefficient, more unproductive, which eventually becomes disinflationary and deflationary.
Okay, so that gives us the opportunity to take it from something more esoteric to something that everyone is talking about right now. And that's, what do you see for the rest of 2025 as far as inflation? And we'll just use the CPI as a proxy for that. And then the long end of the curve, because you got tariffs. Trump's talking about 25% here, 100% there, 80% there. And a lot of people see that as potentially inflationary. And then you've got Scott Bessent coming out and saying they want the long end of the curve down. And a lot of people believe that they have control over that due to issuance and all of these.
That's backwards anyway. We want the long end to go up.
What does Jeff Snider think about 2025 inflation and interest rates, starting or looking at that through the lens of the tariffs and everything that Trump and his team are out there talking about?
Yeah, the first thing I do want to, when he said that he wants the 10-year to go lower, no, you want the 10-year to go up. That means that whatever you're doing is working. And so if you're spending your time fighting against the 10-year going up, you're being even more counterproductive. But he's a Wall Street guy. What else is he going to say? But as far as tariffs and restrictions and trade and all that, are tariffs inflationary? Well, first of all, we have experience with them. They weren't to this extent or to this degree or what they look like they're going to be. But we went through this in 2018 and 2019, and everybody said the same damn things back then. You can go back on Google and look at all the financial or all the research pieces and think pieces that were put out from all over Wall Street in 2018. What did they all say? Inflation, inflation, inflation. The Fed's going to have to raise rates. Oh, shit, it didn't happen. Yeah. By the time we get to 2019, what's happening? Rates are going down. Consumer prices are going down. We had disinflation all throughout 2019. Central bank policy rates were going down because, first of all, there wasn't that much of an impact from tariffs. But if there was any impact, and it was substantial, it was as another drag on an economy. They couldn't afford another headwind, which starts to sounds very familiar to what we're talking about here. So if our base case is that Trump is going to impose some type of tariffs on probably a significant portion of the world, it's likely not to increase inflation or longer run, accelerate prices. There may be a one time or a couple months where prices go up, But after that, it leads to, just like we've seen with oil price spikes over the last couple of years, oil price spikes are not inflationary. They bump up the CPI temporarily, but on the other side of it, they destroy more demand, and it leads to less economic activity and eventually lower prices and lower price rates. I won't say lower prices, lower price rates than there were before. So tariffs are a lot like an oil price spike. CPIs will go up and everybody will go crazy about them. But on the other side of it, you have more destroyed demand because you're essentially robbing from one sector to pay for another sector. People can't afford it. It doesn't create jobs. They don't create income. So the higher prices that you pay have to come out of someplace else. And as they come, the more the tariffs there are, the more that has to come out of someplace else, the weaker the economy is outside of what's being tariffed. And what's being tariffed also experiences substantial setbacks too. So assuming there are substantial tariffs from the Trump administration in the first couple of months of this year, it would actually add more to the scenarios that we talked about earlier in this video, where we said, the sideways economy going over the edge and off the cliff. That would raise the chances of that actually happening.
Right. Okay. So I'm assuming your base case for the end of the year, 10-year Treasury, if we fast forward to December 31st, 2025, 10-year Treasury lower. Would be your base case?
Really, the question is how much. That's the tough one to figure out.
But you think it's going to be lower than 4.5?
Yeah, I think it'll be under 4% for sure.
Okay. All right, guys. On that bombshell, Jeff Snider, thanks a lot, my friend. Why don't you tell people how they can learn more about Eurodollar University? Yeah,
Eurodollar University, like we were just saying, even though the name is Eurodollar University, we're not advocating the Eurodollar system at all. That's the irony here. Eurodollar University, it's just what we said. It's the idea here is to understand what the system is so that we can try to analyze what the implications might be for all the things that happen with it. So Eurodollar University, we're dedicated to telling people the story of the Eurodollar, what money is, how it relates, where do treasuries really fit into all this? Where does the Fed fit into all this? In fact, I actually just expanded. I hired a researcher who's going to be a PhD who specialized in, get this, primary dealers. So we're even expanding to how much information and content that we can give people to understand what the system is and how it's supposed to work, so that we can figure out how it impacts what everyone is doing right now and into the future.
Very cool. And if you want to see Jeff live, you got to get your tickets. Rebel Capitalist Live. He's going to be there, Orlando, May 23rd to the 25th. So you can get your tickets at rebelcapitalistlive.com. And I'm sure the editor will put a promo up for that right now. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow rebel capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets. And I will see you in Orlando, May 23rd through the 25th.